All right, and now for my money chat. It is time to talk about mortgage interest rates and the concern of inflation. Now, you will not want to tune out early on today's money chat, as with any negative news, there is also positive news. So stay tuned for the entire money chat. Mortgage rates are tied directly to the Fannie Mae 30-year bond, and when the bonds drop in trading price, mortgage rates increase. Now, we saw the first drop in the bond market was on January 5th, dropping quickly until January 11th. We did see most of that drop come back from the 12th until the 27th. However, since January 27th, the bond market has dropped in trading price every day. And we've seen midday price changes for the worse a few times throughout that period. Now, the good news, there's actually two good newses here, but first good news is we're still in historical lower interest rates. So it's all a perception. Today's average interest rate is 3.18% for a 30-year fixed rate. I am not quoting interest rates, as they are determined on many qualifying factors such as credit score, loan amount, property type, occupancy type, and other factors. Also, it depends on what you decide to pay in discount points or not discount points. So you want to just definitely reach out to us to get an accurate interest rate quote. You may ask, where are interest rates headed? My answer is no one knows for sure. However, here is my concern and my theory. This is by no means factual, as I'm not a credential economic expert. It is my theory, but I think it does make a lot of sense. So we have three houses of government that all have a very low fear level of spending money and the inflation risk around that. We don't have the divided government. All three branches are under the same control and the same party. When inflation is expected to increase, interest rates will increase, as does the discount rate used to calculate the bond's price increases as well. That makes the bond price drop, and then in the opposite occur when inflation expectations fall. Now, as a buyer, you may be asking, why now, a month later, do I approve less than I did last month? Well, if rates went up by 1%, let's say just over that 3%, and it hasn't gone up quite that. I just want to use easy numbers here. Today's average interest rate, this is still, again, a very low considering the historical interest rates. However, in a $500,000 loan, this lowers your buying power by $55,000. So simple math, every 1% increase in rate, you've lost buying power of $55,000. Or if they went down, same factor. Now, this obviously depends a little bit on the down payment that you're coming in with, but $55,000 in buying potential, this is a significant difference in property and or location. Now, inflation definition, it's simple. Inflation is the increased cost for goods and services. What might cost you $100 yesterday could cost you $105 today. The value of the dollar is worth less, so it takes more dollars to purchase those same goods and services. Who gets hurt from higher inflations? Lenders get hurt from inflation because the money that they lend yesterday is worth less today. Those attempting to get into the housing market during higher inflations times are impacted in the same form because their income savings and the available down payment aren't able to keep up with increasing in home prices, which we're going to talk about. People with fixed incomes are hurt relatively even worse. Now, who benefits from higher inflation? Borrowers, and specifically home owners, benefit from inflation because the money that they paid back for their fixed rate mortgage is worth less today than was yesterday, but it's fixed. The higher the inflation rate, the sooner your home value doubles for those of you who understand the rule of 72. So you may ask, what about home prices? Do home prices raise with inflation? Yes, they do. As the value of the dollar is worth less due to higher inflation, it will take more dollars to purchase that same property. Real estate has traditionally worked well in inflation for hedging. So, do homeowners see inflation good for home prices? As a hedge against inflation, as your home increases in value, it will offset some of the inflation. This is much better position to be in than someone trying to get into the market. For those of you that own investment properties, rentals and rents are increasing. So a call to action, if you are a renter, you will want to take action right now today. Buy if you're in a position to buy with the interest rates still at historical low. Also, as I shared with the risk of inflation, it will take more dollars to purchase that same home. And to sum it up, if you are a renter, higher cost of living, no, your dollar is worth less. Your landlord's most likely going to increase your rent. And also, if you are thinking of buying a rental or a second home, now is the time to take action. That is your money chat.